Are you tired of the myth that only the wealthy can build substantial wealth? What if I told you that you could start your journey to financial freedom with just a few simple steps? In this video, we'll uncover the secrets of dividend investing, a powerful wealth-building strategy accessible to anyone. Stay tuned as we explore the art of picking dividend stocks, uncovering the hidden gems that can pave your path to prosperity. But first, let's unravel the fundamentals of dividend investing, laying the groundwork for your journey to financial success. Dividend investing is a strategy where investors focus on purchasing stocks that pay regular dividends to their shareholders. When a company shares a portion of its profits with the shareholder, these payments are known as dividends and are typically distributed quarterly or annually. Besides the obvious financial reward, dividends offer stability and consistency to investors. While stock prices may fluctuate with market volatility, dividends provide a steady stream of income, making them particularly attractive for long-term investors looking to build wealth gradually. But not all companies pay dividends. Some may reinvest all profits back into the business for growth, while others may prioritize other forms of shareholder return, such as stock buybacks. That's why it's crucial to carefully select dividend-paying stocks that align with your investment goals and risk tolerance. To identify these lucrative dividend stocks, you should understand a company's financial health and dividend policy. Look for companies with strong fundamentals, consistent earnings growth, and a history of increasing dividends over time. Before diving headfirst into the world of dividend investing, it's essential to take a moment to define your financial objectives. Setting clear and achievable goals will serve as your roadmap, guiding your investment decisions and keeping you focused on your long-term vision. Are you aiming to build a nest egg for retirement, save for a down payment on a home, or simply generate additional income? By clarifying your goals, you can tailor your investment strategy to align with your aspirations. Next, consider your timeline and risk tolerance. Are you investing for the short term or the long haul? How comfortable are you with market fluctuations? Understanding your time horizon and risk appetite will help you determine the appropriate investment approach and asset allocation. Once you've established your goals and risk parameters, it's time to create a plan of action. Break down your objectives into smaller, manageable milestones and set specific targets for each. Whether it's saving a certain amount of money each month or achieving a target portfolio value, having tangible goals will keep you motivated and accountable. Remember, flexibility is key. Life is unpredictable, and your financial goals may evolve over time. Be prepared to adjust your strategy as needed to adapt to changing circumstances or market conditions. One of the key metrics to understand in dividend investing is the dividend yield. This represents the annual dividend payment divided by the stock price, expressed as a percentage. A higher dividend yield indicates a higher return on investment relative to the stock price. However, it's essential to consider other factors, such as the company's financial health and growth prospects, to ensure the sustainability of dividends. Another crucial concept is the payout ratio, which measures the proportion of a company's earnings paid out as dividends. A lower payout ratio suggests that the company has ample room to continue paying dividends or even increase them in the future. On the other hand, a high payout ratio may indicate that the company is stretching its financial resources to maintain dividend payments, potentially putting them at risk. Additionally, investors should pay attention to the dividend growth rate, which measures the annualized rate at which dividends increase over time. Companies with a history of consistent dividend growth demonstrate financial stability and shareholder-friendly management practices, making them attractive investment opportunities. When it comes to selecting dividend-paying stocks, investors should adopt a strategic approach to maximize their returns while minimizing risk. Here are some key factors to consider. Number 1. Look for companies with strong fundamentals, including stable revenue growth, healthy balance sheets, and a history of profitability. Avoid companies with high debt levels or unstable earnings, as they may struggle to maintain dividend payments during economic downturns. Number 2. Evaluate the company's track record of dividend payments and dividend growth over time. A consistent history of dividend increases indicates financial stability and management confidence in future earnings prospects. Additionally, consider the company's dividend payout ratio to ensure that dividends are sustainable and not overly reliant on earnings. Number 3. Assess the company's industry dynamics and market trends to gauge its growth potential and competitive positioning. Companies operating in stable or growing industries with strong demand for their products or services are more likely to sustain dividend payments and generate long-term returns. Number 4. While a high dividend yield may be attractive, it's essential to consider the total return potential of the stock, including capital appreciation. Look for stocks with a balance of dividend yield and growth potential, to achieve optimal returns over time. Number 5. Evaluate the company's management team and corporate governance practices to ensure shareholder-friendly policies and transparency. Companies with ethical leadership and a commitment to shareholder value are more likely to prioritize dividend payments and long-term growth. By carefully analyzing each potential investment opportunity, you can build a diversified portfolio of high-quality dividend stocks poised for success. One of the most powerful strategies in dividend investing is reinvesting dividends to compound your wealth over time. Instead of pocketing your dividend payments, you can reinvest them back into the same stocks or other investment opportunities, allowing your dividends to generate even more income in the future. The magic of compounding comes into play here. By reinvesting dividends, you not only benefit from the initial dividend payment, but also from the additional shares purchased with those dividends. Over time, this process can snowball, accelerating the growth of your investment portfolio exponentially. For example, suppose you own 100 shares of a dividend-paying stock that pays an annual dividend of $1 per share. If you reinvest your dividends and the stock's price remains constant, you'll have an additional 100 shares after 1 year. In the second year, you'll earn dividends on 200 shares, leading to even more shares being purchased. This cycle continues, compounding your wealth over time. Reinvesting dividends can also help smooth out market fluctuations and dollar-cost average your investments. During periods of market downturns, dividend reinvestment allows you to buy more shares at lower prices, potentially increasing your returns when the market rebounds. Many brokerage platforms allow you to automatically reinvest dividends without incurring additional fees. This hands-off approach ensures that your dividends are put to work immediately, maximizing their growth potential. Let's shift our focus to the importance of building a diversified portfolio. Diversification is a fundamental principle of investing that involves spreading your investments across different asset classes, industries, and geographic regions to reduce risk and maximize returns. The rationale behind diversification is simple. By not putting all your eggs in one basket, you can minimize the impact of individual stock or sector fluctuations on your overall portfolio. This means that if one investment performs poorly, other investments may offset those losses, helping to stabilize your portfolio's performance over time. There are several ways to achieve diversification in your portfolio. One common approach is to invest in a mix of stocks, bonds, and cash equivalents. Each asset class has its own risk-return profile, so by combining them, you can create a balanced portfolio that aligns with your investment goals and risk tolerance. Within each asset class, diversification can be further enhanced by investing in a variety of securities. Instead of investing in just one sector, such as technology or healthcare, consider spreading your investments across multiple sectors to reduce sector-specific risk. As you build your diversified portfolio, it's essential to regularly review and rebalance your investments to maintain your desired asset allocation. Building a balanced and diversified portfolio can be challenging, but there's a remarkably simple solution that takes just 10 minutes of your time. Watch this video as we compare Vanguard index funds, offering you instant diversification while keeping costs low. Discover how you can enhance your investment strategy and continue your path to financial independence and success. See you in the next video.